Good day, traders. Before we get started, I'd really appreciate all the emails and questions that I've received, and I apologize if I haven't gotten back to everybody, but I'm doing my best to do that. If you could take a second and hit the like button for me, it'd be greatly appreciated. If you haven't subscribed, subscribe. I try to update 2-3 times a week with relevant information that will help improve your trading in real time. So again, thank you very much. Let's get started. Just wanted to mention to everybody that this Wednesday, June 23rd, 7 p.m. Australian Eastern Standard Time, I will be on with Pepperstone live on the charts, and this week will also be Blake Morrow from Pipzar. And again, the link will be below in the description box. Blake will be on with myself, Chris Weston, and we'll be in live time looking at the charts and looking if there's any setups for me depending on what time I'm on. We'll see what the 12 candle window looks like. Leandro Andrada will be on also. And then on Thursday, there will be a couple of other people, Binny Ong, and she'll be going through automated trading strategies, and also Thomas Atkinson. And that's Thursday. Again, you can click on the link below in the description box if you haven't received anything yet. That'll be this Wednesday, Thursday, June 23rd and 24th. And again, 7 p.m. Australian Eastern Standard Time, 5 p.m. for me in the West. I'll put that link below in the description box. It's going to be a great evening and looking forward to doing it in live time. Thank you. Good day, traders. Stacey Burke from Stacey Burke Trading, and today we're going to go over some of the market maker templates, the 3-day setup. This week displayed some perfect examples of the 3-day cycle, as well as using news catalyst, second day trades, and continuation trades after the Fed, and using the calendar. So we'll look at that. We'll just review again real quickly some of the simple concepts. Again, not trying to chase the market and catch all the moves, but letting the market structure set up and understanding that the other side of the chart is the smart money, the institutions, the market maker, and they hold all of the cards. They're the ones making that chart set up for you. They're painting a picture for you to get involved in the market. They're inviting you to the party. And it's important to understand that in order for them to execute their game plan, they need to get other players into the market to take the other sides of their trades. We're the liquidity. And so, I've emphasized this. It's my focus is in this 12 candle window, and specifically, I'm waiting for them to set up the structure Monday, Tuesday. Often there may be trades in the sessions on those 2 days. Those are great days because they're setting up the initial balance. And we talked about this in the previous 3-day cycle, but we'll keep going over this. It's important. And then looking at Monday, Tuesday as the week evolves. So Monday, Tuesday can often bring in other time frame traders if it breaks a previous day's high, a previous week's high or low. Again, especially if we have a structure in place for the existing month. We may be in a month that's making new highs. So we may be looking for a buy-low setup, or if we're looking at a market that's giving a sell-high setup, that it may be limited because we're in an uptrend. That sort of rationale. But as the market is setting up, just keep coming back and remembering that they're setting up a structure so that they can move the market, trap volume, hit stops, shift money from retail money accounts into their bank accounts. So again, Monday, Tuesday typically will form the initial high and low for the week. We may see a retest of one of those extremes for a high of the week or low of the week reversal trade, or we may see a breakout pullback or a breakout consolidation and a continuation for a trend or a measured move of that geometrical structure. Timing is everything. I cannot emphasize this more. I get a lot of emails and questions regarding this. We'll just highlight this. I talk about this. If they go outside of the highs and lows, outside of this timing window, typically that will be at a high of the week or low of the week. But I'm not worried about chasing those moves. They may give great trade setups, but it gives me a bias heading into the next session for when that London market, or especially with New York, when that market opens, because we may have already locked in a low of the day in the gap time or a high of the day in the gap time at major round numbers or whatnot. But specifically in New York, they will often retest the extreme when the equity market opens. So that's important to understand. And in some cases, if they've retested that, and we'll look at some examples of that this week, the open of the market may be a blow-off or a reversal trade if it's a creeping trend. You know, creeping trends are building up volume inside of those boxes. Trap volume inside, whether it's in a 50 pip box, a 100 pip box, it might be a 25 pip box, it might be a narrow range day, it might be a Monday. Monday may not be a big range because they're establishing one of the extremes. They may work one side, pull back inside, and it may just be a 25 pip move, a 50 pip high low. So as the week evolves, our range will expand. And again, some of the pairs, if you understand the average daily range, that can give you a reasonable expectation on what you can be looking for as a risk reward. But as the week unfolds, obviously our risk reward can increase. You know, coming back to some really simple logical things to think about. They know that retail money comes into the market on Monday morning ready to trade. They've been studying all week. They're they might have had a good week or might have got beat up, and they've taken the weekend to recollect themselves, study their playbook, and Monday morning they're raring to go, and right off the bat they're looking for trade setups. Well, the market maker, the smart money, whatever you want to call them, they may take 3 days to set up the big move. There may be 25 and 50 pip moves depending on the instrument that you're trading, and there may be some really good setups as they establish that high and low range. But also remember that they may also be collectively building volume up inside for a larger move, either to pull away from that volume, trapping traders down short or inside, or up high for a reversal move. But again, the structure is what is important. So again, major round numbers, double zeros and 50s. So if they extend out past that to a quarter level, they may be trapping volume in that quarter level above or below the range where they are intending to go. So for example, they may be blowing off into the open of London, 25 to 50 pips, and the market as the equity session opens may be in a 25 pip box below 50 for a 50 pip stop hunt in the opposite direction. They consolidate it. We get the engulfment pin hammer at the end of that 3-hour window, and the market either moves fast and aggressive depending on the setup of that's in place, or they may consolidate on top of that level or inside of that box now, and as we head into the U.S. session, go back the other way. So my focus is at the high and low of the day, high and low of the week. And I'm, depending on how the week sets up, we may be in a range-bound week, as we saw last week on the pound. We could be in a trending week, which we saw this week on the major pairs as well as gold. And we'll look at some examples of that. Or we could see some fantastic reversal trade opportunities, which we will also look at some examples of that. Engulfments and pin hammers are what I'm using 15-minute charts to look for these setups. But again, I'm looking to enter in at the level on any time frame, whether that's a 5-minute, a 1-minute, 15-minute. But timing and level is the key once I have evidence that they have locked in the high or the low of the day. So one thing I did not put in here is, again, I look at the news calendar as a possibility for a catalyst opportunity or a second day trade, as we saw on the Fed. We'll look at some examples of that. And in some cases, depending on the announcement, the Fed typically can spike both sides. We can look at that on the BOE for the pound cross pairs, interest rate announcements, unemployment, obviously non-farm payrolls. But these are some examples where I will often stand aside and wait, even if it's 5 minutes. There can often be an opportunity, but that would come with the setup that's there. I'm not looking to get in front of the news, but most importantly, what we're looking at today is the example of the template, and I'm just planting that seed to understand that they may be setting up a larger structure over the course of 2, 3, 4 days heading into a major news release. We often see this on the BOE. We saw this on the Fed. They'll bring the market up high to drop it right down. They might take it up 3 days and then just in one hour take out the entire week's range. So if we take a look at the euro, again, we saw the big move down on Friday. We know coming into this week that we had the Fed on Wednesday afternoon New York time, Thursday morning Perth time. But again, I talk about with most of the major pairs, I'm quite happy to let the week set up and just establish my high and low, my Monday, Tuesday initial balance. And again, just understanding what that's giving me. That's giving me my two areas, my two extremes, and just looking at our numbers, you can see 50s and double zeros. So I'm not even looking at any of this. I'm just looking where's the high, where's the low as we come into Wednesday. Now, this is not an area or an announcement that I trade. I'm in bed at this time, but some traders may want to participate in this. Often with the Fed, it's risky because they can often spike up first or down, depending on where they're going to go, and then obviously take the market in the opposite direction in the second minute. But if we were to go to a 5-minute chart, and again, just seeing that this is still almost 75 pips, but some traders, again, understanding that this momentum may carry through, and they're prepared to take that trade with a tight stop. But most importantly, what I look for on a situation like this, when we see the market blowing off into the close, is a second day trade opportunity. And you know, this is not hindsight. This is just simple high and low. Rectangle consolidation for a continuation at major round numbers heading into a session timing window. Again, I emphasize the importance of timing. Timing is everything. Think about what's happening. Go to work when the smart money goes to work. If you're trading in here, there may be an opportunity in here into the close of Asia. But again, the closer I get to this window is when I'm going to start to look to see if there's any evidence of institutional money coming into the market. But we got a high put in place in Asia. We have a retest heading into the end of the Asian window as the Europe London 12 candle window opens off of major round numbers, double zeros, and the previous day's low, which again, you'll notice this is the actual consolidation after the news. This is a perfect second day trade setup. It doesn't get any better than this. So this should be a screenshot. Put it into your playbook. That's as good as they get. No pullback. And again, where do you get in? There's traders shorting this on the bear pin hammer heading into the last hour of Asia. There's traders shorting this, recognizing that this market can possibly be a runaway second day trade on the drop down. There's traders just getting in around numbers on smaller time frames. This is a 15-minute chart. Remember what I said. I'm looking for the level, and they've put a high in place at round numbers at double zeros. I have no idea why, in this instance, where anybody would be looking to go long. Now, as the market's dropping down, again, there'll be traders shorting the bull candles or shorting the break of the bull candles. Same thing as we head into the U.S. The market continues to fall. We have now an acceptance of price below 50. We have stops below 50. The market just keeps working lower. They pull it back in the quarter level and drop it down again. So if you're not sure where you get in, then you need to print off your charts and study these types of moves. And remember what I'm talking about is what I look for. And what I'm not trying to do is trade this stuff inside. I'm not interested in this. I'm looking for when is the market got volume consolidated and it's going to move. I want it to move. I want to get in the market and I want it to move. So I'm putting these pieces together, and when it doesn't behave that way, I'm not sitting around for 4 hours hoping that it goes in my direction. I'm going to get out. Or it goes and it does what it's supposed to do. I'm taking profit, or I'm scaling out and leaving a trailer in, whatever that is, depending on the setup and the type of template that we're in. So coming back to day one, so we said day one, day two. Now, look at the type of charts. So one of the things that's really important is to look at how well is the chart structured. When you get a really clean chart, they went down and made a low. They went to the low again. They went to the low again, pulled it back inside. The next day they go up and they put a high in place and they pull it back inside and they stay inside. This is a very well structured chart. Look at where it's at. Underneath 50, on top of double zeros. That's a 50 pip box. This is a very clean, well-structured chart. This is set up perfectly for a trade. We go into the next day. It's a narrow range, very tight consolidation. I wonder why. That's because they want to trap traders, getting them inside of a nothing day before they explode out. Hit stops, trigger breakout orders, whatever they're doing. But step back and let the market set up. The same thing in here. People are trading inside of this. Let the market set up. Let them make a low and make a high, and let them show you their hand. When you get structure, now you've got volume, and there's a reason for this volume to be here. So they can obviously hit stops or trap that volume, shift away, but don't. I never want to be inside. So we go into our Friday, and again, the same principles apply. We have a previous day's low. We're in a downward trending market. We broke out of the Monday, Tuesday, Wednesday range, the 3-day breakout. So we're in an actual downward moving market. They set up a high in Asia. They go up first. What does that tell you? They go up first and come down. They've put a high in place. Now they come down, trigger breakout traders, and then pull it back inside. Traders might be going long, back to the high, but we get 1 push, 2 pushes, 3 pushes in our gap time. The gap time. So I'm not trading in here. So again, understanding that we've got major round numbers. We're at double zeros. They've hit the previous day's low. We have other time frame traders in the market. They come back in 3 pushes. We have higher lows. As they roll over into the open of the 12 candle window, we are already in acceleration of a blow off move. We have a 1 bar stop. So keep it as simple as possible. Like, this is a super clean example of a market maker 1, 2, 3 setup. Monday, Tuesday, Wednesday, using a news catalyst, a sideways consolidation underneath the previous week's narrow range day zero setup on the Thursday. So you'll notice, again, the choppy market. They chop it up and down, doesn't go anywhere. They go sideways. They go back up to retest the high, drag it down, and go sideways underneath as we head off into the Fed. So again, they build up a box. They stay inside. Median price is 25 before, boom, exploding out. Second day trade continuation and the follow through on Friday. Looking at gold, again, I'm just emphasizing process. It's got to be so simple so that you're not sitting there every day making analysis paralysis. And again, some simple stuff. We have a big move down on Friday. We have the low of Thursday still intact. They haven't hit it. And we have the low of the previous week's Friday from payrolls down low. We talked about this the other day. So an example of a second day trade. When you see these narrow consolidations after a move down, a big move down. Now this is somewhat of a creeper, but it's a runaway. This is before the Asian sessions even started. It's already broken out of its geometry. So not trading. Let's say you're not even trading any of this. Okay, the only place you can go is down. There's no evidence of traders. If you're counter trending this, you're counter trending a massive down leg. There's no evidence of 3 pushes. So we got 1 push, 2 pushes, and we get our third push keeps going. So it breaks the doji. And again, we talked about the different time frames. On the 5-minute, we had a pin hammer at 50. We got price acceptance below 50. But timing, again, the timing is everything. Continue down on Friday. So remember, Monday, Tuesday, Wednesday. So we've taken out the low of the payrolls Friday. We've taken out the previous week's low. We've taken out yesterday's low. Now we also have evidence of a creeping trend now. We talked about this. We're Monday, Tuesday. I'm expecting a peak formation possibility. They go into consolidation, give us a pin hammer and an engulfment as we head into the equity session. And we showed this on the 5-minute chart in the last video. A beautiful pin hammer, first bar of the New York equity session on the 5-minute chart. And it just rocketed it up. Now this is a textbook perfect squeeze setup trade for an explosive move. These trades, we're going to look at one from Friday. Brilliant. 3 levels down. 1, 2, 3 into the session open. Sideways consolidation, engulfment, pin hammer, explosive move straight up. So we have our peak formation low. The market stays in consolidation and trades into the peak formation that's formed at the end of the U.S. session and comes down for a 50 pip stop hunt on the trap volume. So again, talking about, we're not going to go into 3 levels of rise and fall, but again, there's always 3 levels in every session. We saw this into the close, 1 push, 2 push, 3 pushes. On the 5-minute, we saw the 50 pip stop hunt come down, straight down into the open. And it's just coming back to the basic concepts. Trap volume, hit the stops. Look at the box, 50 pip box, trap volume. They come down first. They're coming down. They're putting a low in place. They put a low in place. They go back up to the high. They put a high in place. So now we have a high of the day in place. They've taken out the Asian high. They go into consolidation. They put a peak formation in place for the day, for the session. They go into consolidation. They go back up, pin up into the high. Here's the low. Okay? There's our high. They're in consolidation. So anybody trading in here is getting caught in chop. They're getting jammed in, not going anywhere. And you'll notice they pin up, pin down, go back up one more time. After the equity market opens, the doji breaks the low. They hit the stops, continue down. So now we have our Monday, Tuesday. Okay, so our Tuesday high is below Monday's. There's our initial balance inside Monday, Tuesday's high low. The market pulls back inside, goes into consolidation. So we're inside of Monday's low and Tuesday's high. We have a 250 pip box. We're heading into the Fed. Do you notice, again, similar to the other pairs, narrow range consolidation prior to a major news release. Whenever you get jammed inside of a 50 pip box on gold, even 75 pips, but the volume, as you see, heading into the announcement, is up in that upper 50 pips. They jam it in up top and then boom. So they've pushed the volume up high in that box underneath of Tuesday's range, inside, and now we have a 3-day consolidation of volume before exploding away. Now again, I'm not talking about trading the Fed, I'm talking about looking at the big picture, but we head into the next day and there's a beautiful second day trade set up. They creep it up, they take it 50 pips above the 00 box, they go sideways, drop it down, and then we have the engulfment back inside of the 00. So you're going to see this over and over again. And people who talk about hindsight trading and everything else, you're going to see the same thing. They locked in the high. They locked in the high. They dropped it down. They went sideways. They dropped it down again. This market heading into the Europe 12 candle window is already blowing off. Okay, remember, where's the money? Look at where the volume's trapped, all in this 100 pip box. They take you up first and keep you up inside of that 50 pip box. As soon as they break through here, they're done. They're not going back. Pull back into the equities open, they drop it down and it runs away. A second day trade setup. When you see this opportunity, there'll be traders trading it up in Asia. Again, they brought it up 150 pips. 150 pips. That's 3 50 pip levels of rise. They drop it down. Same thing, we're blowing off into the U.S. session open. But the equities hour pulls back. So again, there's a 150 pip pullback. And again, on the smaller time frame, we got a beautiful retest into the 00s. We had a engulfment on the first hour. They pulled right back into that and boom, dropped it down 200 pips. Friday was an absolutely perfect day. Screenshot this. This is as good as it gets in terms of understanding 3 levels of rise and also understanding the market maker, how they will create the structure in place in order to get volume into the market. Asia comes up. They bring it up in Asia. All the fills, notice every fill, they're making you buy it higher. The market consolidates after Asia. So after Asia, we have a high that's made in the gap time and a low, a new high and a new low in Asia heading into the Europe-London 12 candle window. At the end of the London open hour, the second candle, we have a bullpen hammer Remember, this was the high. They made a new low. Heading into the window, they came back down into the low. They're making you buy higher. Bullpen hammer, 50 pips, straight up. It goes 75. We're making new highs. We're still going up. But then we go sideways in a 50 pip box, and in the gap time, they pin up 50 pips before engulfing it in the gap time. Now, you see, if you take this trade in the gap time, you're sitting there for 2 more hours. You might have taken it on the engulfment. You might have tried to get filled at the quarter. You don't need to do that. You don't need to do that. Come back when they're going to move the market. This is now trapping volume or just making people sit and wait. And what do? Right near the end of that last hour prior to the 12 candle window, the stop hunt hour, boom, they take it up one more time into traders that are short already, who've shorted this, whether it's the 15-minute, the 5-minute, 1 minute. They might have shorted at 50, but they put heat into them. So if you've gone to break even, or depending on what your fill was, you might have been stopped out. But we have 1 level of rise, 2 levels of rise, 3rd levels of consolidation with 1, 2, 3. They've moved this up 250 pips from the beginning of the day. 1 00 box, 2 00 box, 50 and pinned up into it, went sideways, engulfment. Now again, on a smaller time frame, this rolled over on the 5-minute and the 1 minute and literally blew off 100 pips in 15 minutes. But coming back to the rationale, understanding that they're bringing you up high. They're bringing you up high, especially on gold. When they trap volume on 3 levels, they will not come back. And people who counter trend this market will get smashed. This is a textbook perfect day for 3 levels of rise and then consolidation and an explosive fast move. This, you could be trading in here. You could be trading in here. People might have went long here. But when you get this opportunity in the consolidation and you can count 1, 2, 3, and they give you this setup, this thing is going to move fast and hard. This is an opportunity that I look for scalable trade setups. That's fantastic. That's a perfect setup. Now, again, just looking back at the initial template, this is a beautiful example of a day 1, day 2, day 3, using a news catalyst opportunity for that, not to say to get in front of that news, but understanding that there's opportunity building in that consolidation. 2nd day trade, you may have taken this trade down on the smaller time frame after they've hit the stops. So again, this is so typical. On Fed and BOE, they'll take traders into the wrong direction just prior to the news. They pin the stop, so if you're in early, you're hit. And then this, if you try to short that, your fill may be down 50, 75 pips. So again, I'll wait until that market has traded for a few minutes. If I am going to get into that market, 5 minutes, 10 minutes, whatever, it doesn't matter. Or I'm just going to look for the 2nd day opportunity. Now, this was just a beautiful trade setup. And again, I know traders that email me, this just continued to fall all day, all session. You could not, high risk to counter trend a market like this. Just trade with the trend. It's an all-in day. And then, of course, they come back to get some of the money. 3 levels of rise, getting traders chasing the reversal day before consolidating, and then boom, taking it right back down to the bottom, wiping out the whole day's structure and closing below the low of the week. So hopefully you got some value from today's video, traders. Day 1, day 2, day 3, that can give us a massive amount of information. I'm not looking to try and catch pips every day. I'm looking for the opportunity when they lock in a low or a high and they're going back for 50, 75, maybe more. Gold just gives fantastic opportunities. Keep it simple. Print off your charts. Identify the best trades that you resonate with, whatever instrument you're trading. Study it. We saw the same thing happen on the cryptos this week. Most of the major pairs, the S&P did the same thing. They're all the same. They have market makers setting these markets up every single day. Their sole intent of purpose is to trap volume and hit stops. Keep it simple. Have a great trading session. Enjoy your weekend. Study hard. Keep it simple, and may the markets go.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, The 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.